Thank you, Donna, and welcome everyone. This is Russ Kaney. As Donna mentioned, I work for the Rural and Native American Initiative within Enterprise Community Partners. And I appreciate taking the time on a Friday afternoon and in the middle of the holiday season to join us and talk a bit about single-family housing and some of the capital resources that are available for single-family housing. With our group within Enterprise, we are involved in both multifamily housing and in single-family housing, but as we go into 2018, we see more and more opportunities in the single-family housing area. And so really wanted to take some time today to talk about the single-family landscape and some of the opportunities that are out there in rural America. Today, we're going to talk about kind of the general single-family housing landscape that happens to be across the country right now, and talk a bit about owning versus renting a home, and dig into a little bit about the psychology of the market right now and perhaps some of your clients and people that you are working with, and how the recession of about almost 10 years ago now affected the single-family housing landscape. And then we'll be talking about some of the resources that are out there, not only in the areas of loans and grants, but also infrastructure and just local capacity. And then we'll wrap it up with some information and websites that may be of particular interest to you and help you get some additional information for your own programming. So before I start, I know that everyone may not be completely familiar with Enterprise Community Partners. We are a nonprofit, a national not-for-profit, and an intermediary, and have been involved in affordable housing since 1982, so created about 35 years ago by Jim and Patty Rouse. Jim Rouse was a developer on the East Coast, did mostly commercial buildings and shopping malls, and as he neared retirement and got older, wanted to give back and started looking at how he could become involved in community development, affordable housing, and started Enterprise as a vehicle to do that. Today, Enterprise is a much larger company from its origination. We have over 500 employees. We're involved in providing debt and equity and technical services for the low-income housing tax credit program. We're also involved in the New Markets program. We have a community development financial institution, the CDFI, a loan fund. Many of you may have been familiar or have been familiar or working with Green Communities, which has been in existence since 2004, which brings efficiencies to affordable housing. We have a Rose Fellowship program, an architectural Rose Fellowship program that's available across the country, and we'll actually be looking at new sites for 2019 starting in January and February. And then we have a policy office that is located in Washington, D.C., but over the last number of years have also been placing individuals in some of our market offices across the country working on state and local policy, which has become a big driver, and obviously with funding and many other issues coming up on housing and the economy, the policy office follows those issues for us closely. We do have a nationwide platform. As I mentioned, a lot of activity in our market offices across the country, but the Rural and Native American Initiative is a nationwide program, coast to coast, and get involved with many not-for-profits and CDCs across the country, both in rural communities and Native communities. So let's just step back a minute and take a look at the single-family housing landscape. Single-family has been in the news, obviously, for the last 10 years. We've had our highs and lows, and as we led up to 2007, of course, we had a lot of activity in home ownership, and we saw home ownership rates get to some of their highest levels ever in 2004. Kind of the housing bubble, if you will. And more recently, though, it's dropped back to about 64% home ownership rates in the country. Now, if you look at the percentages, you think, well, that hasn't dropped very much. But if you think about the percentages being 1% equals about 1 million households, then it's a significant number to make this number move. The United States, with its home ownership rates, are probably about in the middle of the range of developed countries when it comes to percentages of home ownership rates. As you'll see, China has a higher home ownership rate, and surprisingly, Germany in Europe has a lower home ownership rate. So it is a little bit all over the board, depending on what area of the world you happen to be in. Rural home ownership rates, interestingly enough, tend to be higher than urban rates, and you'll see some of the states that I listed here having extremely high rates. South Carolina, Utah, some of the Midwestern states have higher percentages than the U.S. average. And then, as you might expect in states where some of the single-family housing pricing has become an issue, high-cost housing, California obviously comes to mind, New York, the state of Hawaii will have lower percentages. So as we've gone through the recession and forward, we've seen the home ownership rates drop, which then has caused the rental rates to go up. So in 2007, we were about 30% of households that were renting for their households, and that has gone up to 37%. Probably more importantly and more distressing is that of the rural renters that are out there, 47% of rural renters are considered to be cost overburdened. And typically, cost overburdened means that they're paying more than 30% of their income towards the rents. And of the overburdened, 50% of these individuals or households are paying more than 50% of their income for their shelter or housing. And we've seen many stories, and this has been amplified by different organizations that have been out there. Particularly, I'm thinking of the Make Room campaign that's been out, really trying to highlight some of the issues over high rents and the availability of rental units across the country. So we all pretty much know the economic benefits of single-family housing. Obviously, it's a job creator, new construction, rehabilitation of units, just the whole industry in and around single-family housing market does affect the economy, does provide lots of jobs, lots of industries. You think about who's just out there in your local communities that's involved one way or another with single-family housing. Realtors obviously involved, construction firms, although we've seen construction firms that probably fewer of them due to the recession and due to just a drop-off in activity, particularly in new home construction, just a very large industry in the product line, whether it be lumber or just individual components of a home, not only for new construction, but rehab. And of course, a lot of these firms have been involved and active even when single-family housing was not as active with new construction, because we've had the run-up in the rental market and lots of construction there, and the commercial market. And then, of course, the financial services area employ a great number of people, banks, credit unions, mortgage brokers in this area. So owning a home has its advantages, and I pointed out a few here, and I think that most of us know these, but I think it's well to keep in mind what some of the advantages are. And many times when you're out dealing with your clients, and if you have a home ownership program or you're promoting home ownership or whatever piece of the puzzle you're involved in, or just for general information, giving credit counseling or home ownership counseling, these are some things to keep in mind. And really ownership is versus renting allows you to build an asset, and you're building equity within that asset. And of course that is equity and building an asset over time. So it's not a quick fix. It's not something that's going to be immediate, but you are building that asset. You are also having some control over that asset. If you're renting, you are typically on a yearly lease or a month-to-month lease. You are looking at potentially increased rental rates as you move from one year to another. You do have control over not only the unit itself, the home, but also perhaps have some control over at least what your mortgage payment may be. There is some sense of permanency, a security in owning a home, knowing that it's yours. You've got some obligations that you have to meet, obviously, with owning that home, but there's no one that's going to come along and take you out of that home because of some rent violations or something along those lines. You have just the security, the permanency, pride of ownership, and then to a certain extent you have some tax advantages if those are available to you. I put this last because I'm not emphasizing interest deductions or real estate tax deductions. And in fact, some of these issues are up in the air right now with just the debate over tax reform. But they are there, and some people can take advantage of them, and some people do not. I will just note that I did not state here that owning a home is a great investment, and I think primarily a home should not be looked at as an investment, should not be looked at as a piggy bank for equity that you can draw money out from for perhaps your next vacation, or even as an alternative 401k or retirement plan. Should be looking at and emphasizing that a home gives you some of these advantages and is your shelter, and with the added benefits of potentially being something that builds equity and provides some additional security for you in the future, for you and your household. So there are some disadvantages, and maybe disadvantage is not the right word. Maybe obligations, some home ownership obligations that you would not have if you would have rather if you're rather than being a renter. And obviously, the first one that comes to mind is it is an asset that you have that is illiquid. So if you're a renter, you have an opportunity to move out and move somewhere else after a month or after a year lease, whatever that time commitment might be. With a house, it takes time to sell a house. So if you have a job change or if you have a reason to move, it takes a little bit longer, a little bit more time to be able to dispose of a residence and move out. The home maintenance issue is going to be all in your lap. All of the out-of-pocket money that is going to go into home maintenance is going to be yours. If you're a renter, of course, you can call the landlord. If you've got a leaky faucet, something's backed up or plugged up, it's easy to make that call and get it fixed, and you'd expect it to be fixed. But with home ownership, this is going to be on you. And so it's just one of the obligations that you're going to have. Real estate taxes, in many states, they can be high. In many other states, they are reasonable. If you're a renter or you have not owned a home before, many times you don't realize the real estate tax burden and what real estate taxes are actually paying for. If you take a look at your real estate tax bill when you become a homeowner, obviously schools, the library, the fire districts, the county, city services, sewer and water districts, pensions for public employees, many different things are paid with real estate taxes depending on where you are. So this obviously can be a number, a high number. It has to be worked into a budget, and is, again, one of the obligations of coming with owning a home. As does insurance. Insurance, as we've seen over the last year with the number of disasters around the country where we've had hurricanes and flooding and fires, insurance becomes doubly important from the standpoint of protecting your asset. This would be in the worst case scenario, but you never know what's going to happen, and insurance typically, obviously, being required by your lender, but for other scenarios where you have other people involved, you're going to need to have adequate insurance, and that comes with a cost. And depending on where you are and your perhaps your location and proclivity to some of these natural disasters, your insurance could be higher in some areas than others. But again, something that you have to build into your budget. And then financing issues, just understanding and educating yourself on rates and lenders and down payment requirements and credit issues. Many individuals and households that do not own a home, have not owned a home in the past, are unfamiliar with many of these financing issues, and they'll be looking for counseling, looking for people to help them walk through some of the issues that they'll have to deal with just in getting the loan and understanding the loan terms themselves. Anyone applying for or looking at buying a home needs to understand all of the issues, including the financing issues that they're going to have to deal with. Many times, first-time home buyers and individuals are looking to their family or they're looking to their friends for advice. Sometimes those friends and sometimes the family do not have current information about what's going on. The mortgage industry, the availability of funding for certain programs has changed over the last 10 years. So they may have gotten involved in financing their home or involved in buying a home a number of years ago, but it may not be applicable now. So the credit counseling is a very important piece of getting started in educating your household about getting to the point of understanding the total commitment that you're going to be in. And then budget discipline is, again, an obligation, and this would not be just with home ownership, would really become if you're a renter also. But you're going to have monthly payments and insurance and taxes and repairs along with your normal living expenses and vehicle loans and student loans and many other things that are going to be pressing you for some of your dollars. So being able to create a budget, being able to figure out whether you can afford to own a home and at what price point, what type of value or what type of price point can you look for in a home in your particular area. So I wanted to take just a couple of minutes to talk about the recession. 2007 to 2009 were the official years of the recession, 2 years of recession, but as most of us know, there was a huge hangover effect from the recession, and we are in 2017. So a good 10 years after the recession started. And I think, psychologically, the recession, at least on a short-term basis, has affected home ownership and just the thinking about home ownership and people's attitudes towards home ownership. And I think as further we get away from the recession, and as the economy has gotten a bit stronger, unemployment is lower. Fortunately, interest rates are still low. We're starting to see millennials and others, just other households that are starting to look at buying a home and getting out there and being more active and talking about it. I think these are all positive signs. What happened in the recession? Well, the markets just froze up. I mean, there was just a lack of capital, as we all know, because many of us lived through it, and were perhaps involved with households or lending or in the real estate market one way or another with affordable housing or some other piece of housing, that there weren't a whole lot of options available for buying a home during the recession, and a lot of it because there was such high unemployment, people losing their jobs. And if you recall, even the secondary markets had issues. Fannie and Freddie went into conservatorship. And leading up to that, the housing bubble was generally, as we go back and see some of the stories and some of the research that's been done, is that there was an easing of credit and some very loose underwriting, and mortgage companies and others many times are doing this for the fees and not worrying about the repayment of the loans because they weren't going to own the loans anyway. So you had an abundance of foreclosures in the last decade, over 20 million foreclosures, and that led to then short sales and inventory of homes that many lenders wholesaled those homes out. They sold them, and it wasn't necessarily to individuals that were coming into the market and buying them on a one-off basis, but they were selling them to investors who looked at the single-family housing market and saw an opportunity to rent those homes in a pretty strong market from a rental standpoint, mainly because so many people were being foreclosed on or losing their homes. There was over 7 million households that lost their homes between 2007 and 14, which is a substantial number. The 20 million that went into foreclosures is a huge number. And so it caused a lot of distress. So if you were one of those homeowners that were unfortunately had to go into foreclosure or lost your home, or even were in a situation where you had to do a short sale or even negotiate with your lender to keep your home, or if you were a family member that were in one of these homes and lived through that and saw the stress that may have put on the head of the household, or saw the stress that it put on another family member or friends of yours, or even the stress of losing a home, psychologically that can perhaps cause you to step back and think, why would I want to own a home when I've just seen this happen to my family or someone within my family or someone that I know, and cause these types of issues. So I think the further we get away from the recession, the better. As we all know, there were market reforms and some restrictions that came out after the recession. Probably the pendulum swung quite far the other way. And so I think it will probably swing back, and we'll be seeing some additional programs and some additional help for homeowners, hopefully, in the future as more and more people start getting interested in the market and there's more demand for single-family housing. In the overall underwriting of single-family homes with lenders, they are under more restrictions, much more scrutiny on their underwriting, particularly selling off loans to the secondary market. The fallback position for most lenders was going back to the old 80-20 structure, where 20% down payment on the purchase of a home, 80% financing has been a standard. You don't have to have mortgage insurance under that scenario financing, but the issue becomes who's got 20% down on a home, particularly as the home values have started to come out of kind of the basement and started rising again. So this puts a lot of pressure on the first-time home buyer and particularly the lower income wage earners, which in many cases is what we're counseling and dealing with in rural areas across the country, where you have limited inventory, interest rates are still low, but you still have stagnant wages, lower income wages. So really need to start looking at alternative programs and other things that might be out there in your rural communities. So I just wanted to highlight a few programs that are out there, and many of you that work in rural areas and work in the rural sector are maybe aware of these programs, may not be aware of these programs. If you are, maybe I'm shedding a little bit of light on something new about them. I'm hoping that some of you are aware of them, using them perhaps. If not, then maybe dig into them. There's some links at the end of this presentation to look at and get into more direct information and assistance about these programs. There are very few federal agencies, in fact, probably just a couple, that make direct housing loans, and the USDA Rural Development is one of those agencies, one of those platforms that happen to be out there. And they have been in the direct single-family housing loan business going back to 1949, 1950. So this is an old program. It is a program that has been able to finance millions of homes across the country. Had its heyday really as far as the most funding available, probably in the late 70s, in the early 80s. If you remember, in the late 1970s, Jimmy Carter was president. He came from a rural state. He made rural development, the old Farmers Home Administration, the credit agency for rural development, and so a lot of additional dollars went into lending programs for rural communities, rural development, including single-family homes. So the 502 Direct program, a long history. It's been targeted money for lower incomes, 80% of area median income or lower. It does have a break-off also of at 50% area median income for some of the dollars that they get. So they do put a note rate on the promissory note based on what it costs to borrow money from the Treasury, but they do have the ability to subsidize the interest rate down to as low as 1%, which is very helpful to a family that has limited income. They are able to amortize the loans over 33 or 38 years of financing. Probably the biggest attribute of the program is that you don't have a down payment requirement. So you do have closing costs, and many times those closing costs can come from other parties, but you don't have to come up with that down payment, which many times can be the biggest barrier to anyone that has a lower income, a household income, and has to try and to make that work, not only on payments and your taxes and your insurance, but then trying to save anything after all of your other living expenses for that down payment. So the loans are processed and they're serviced by rural development, which can be good and bad. I say good because you are getting some a live loan person and they service their own loans, so you have somebody to talk to. But with the rural development process and the delivery of their loan programs, it's become a bit more difficult because of the contraction of the agency and the contraction of the programming and contraction of rural areas around the country. They have definitely had a reduction in their staffing for running this program, so they have fewer area offices now. They used to, when they had lots of money back in the 70s and 80s, had maybe an office that would take in loan applications and service their loans. in every county or every 2 or 3 counties in every state in the country. Now, and I'll just go back to my home state of Wisconsin, they have 6 area offices, whereas they had many more offices than that years ago. So that's put a strain on the speed of processing and actually puts a strain on the individual or the household that's applying for that loan, because in many cases you would have to, in some cases, engage with that office and have to drive a number of miles to get there if you can't do it on the phone. What they have been looking at lately and have been doing training around the country is to work with third parties to be able to package these loans and put them together and put them on the desk of rural development to speed up the process. A few years ago, the Rural Development 502 Direct Loan Program was not spending all their money. And this was a great concern for many that were out in the field and practitioners and just people watching the federal budgets. Because as most of us know, if you're a federal agency and you're not using your money, the first thing they look to would be to cut that budget and reduce the amount of dollars that you have. Fortunately, in the last couple of years, the monies in this program have been allocated and have been spent. So the appropriation for this program currently is about $900 million, and that equates to about 7,000 loans closed annually, just perhaps a little bit over that. The average household income for this loan program is around $31,000, so it is targeting families and individuals of lower income. The average loan about $128,000, and again, I'm just using an example of Wisconsin. There's statistics out there from USDA on most states, and you can find that on their website as to prior loan activity. It's a little bit behind each fiscal year, but as an example, in the state of Wisconsin, they made 123 loans, 502 direct loans in fiscal year 2016. And although this doesn't seem like a lot, it is helping 123 households in Wisconsin. And of course, you have some states that do more loan activity, some less, depending on the amount of eligible area, rural area in the state. Again, the delivery system is a bit under stress, and as I already mentioned, fewer offices, fewer employees at USDA. So I think the reliance on the loan packager system, the loan packagers, will be important in the future. There is training that's ongoing around the country for loan packagers. There is a fee that you can earn for doing this. And so anyone that is interested as an organization or an individual that wants to become a loan packager, this may be an opportunity to have some direct involvement in the future of households in your particular area, region, state, and become well acquainted with this program. Typically, if you're as a certified packager, you're going through some fairly intensive training. You're becoming essentially an underwriter. Not the official underwriter, can't approve the loan, but you're basically putting a loan package on the desk of USDA that they can quickly review. And if you're doing your job as a loan packager and you understand the underwriting, would go fairly quickly through their process subject to funding. So another program at USDA which has really taken off, and it's a newer program. It doesn't go back to 1950. This is a program that's more has its foothold late 80s and going into the 90s, but really kind of exploded here during the recession and just after the recession of 2007 to 9 is the loan guarantee program by USDA. And most lending activity that we think of, VA guarantees, FHA, USDA guarantee, works on a similar basis that a lender would be very familiar with the underwriting. They're an approved lender through the USDA system. They understand what USDA needs in order to issue a guarantee on the loan. The lender, if they're basically a rural lender, they want to get involved in this program, many times they'll want the guarantee because they may be in an area where there is limited employment, limited income. You do have, of course, the break of going to a higher area median income for your borrowers or your household. So again, I just took an example where we were looking at the average income for a household under the 502 direct program of being about $31,000 per year. You've got an example here of Sauk County, Wisconsin, where a 1 to 4 person household can make up to $79,150 to qualify under the guaranteed loan program. Now, I will point out that both for the 502 direct and the 502 guaranteed, because they are USDA products, backed products, they do have the additional eligibility, not just of income, but the eligibility of being in a rural area. So it is important that as you're counseling individuals or households, that you do check the maps they typically have on the USDA websites where you can put in a zip code and they'll give you a fairly accurate idea of whether you are in an eligible rural area or not. The eligible areas in most states are being reviewed right now. There is a 90-day comment period out since November 30th on eligible areas, and each state is taking in comments. They typically are reviewing their eligible areas, rural areas, if you will, every 5 years, and typically this comes after the census is done and then comes after the American Community Survey was done in 2015. So that's out there. You may want to check the USDA website and check to see in your particular state if there's any communities or any areas where you may be thinking of applying these programs or looking at these programs and seeing if they're truly rural or if they're perhaps ineligible because of population, or maybe they're being discussed right now during this this 90-day process to make that decision. And this is just not to take areas that are considered rural and make them ineligible. There are also areas across the country that are being looked at from the standpoint of coming back into the program because the communities or the area has lost population, or there's been some other circumstances that have come about where they could be considered rural. So this is a very popular program, very efficient program. Again, the lenders are doing the underwriting. It's up to you as an organization or the individual or household to be aware of lenders that might be participating in this program. There are a list of lenders, again, available and easy to find who's participating. They can explain the program very well. They do the underwriting. They do the documentation. They present it to USDA. USDA generally looks at a 3-day turnaround to provide their guarantee. They issue a guarantee for the lender. And you've had a good staffing of this guaranteed program across the country. You see where they are making in 2016 about 134,000 loans. So compared to the 7,000 loans that are being made under the direct program, substantially more activity here. They do have to get loan authority, guaranteed loan authority through Congress each year. They've been appropriated recently over the last number of years, about $24 billion with a B billion appropriation. So you can see in 2016 they used about $18 billion of loan authority, so there's still room there for more activity. And I think the interesting thing in just going through and finding some of these statistics is that you saw loan volume double from 2008 to 2010. Again, a lot of lenders relying on this program when the other capital markets froze up and some of these other programs just weren't working. So I did want to highlight just a few other loan programs that are out there, and not necessarily just for rural areas, but I think obviously should be looked at just because of what they do and their clientele and who they're targeting from the standpoint of making loans. The Veterans Administration comes to mind. As most of us know, there's over 2 million active military. This program makes a lot of loans every year. Just going through the VA numbers in fiscal year 2017, they made over 700,000 loans, which is a lot of loans. And the loan size, about 255,000, and this is across the landscape of the country, not just rural areas, but urban areas. And again, no down payment with a one-time fee and a lower fee if you have some down payment that you could offer. And then they're going with some of the loan limits, minimum loan limits in rural areas. So definitely, if the qualifications are there to qualify for this loan, something to keep in mind and something to talk to a lender about, or at least be aware that this program is out there. Some of the eligibility requirements for the guaranteed loans, obviously veterans with completed full-term service, honorably discharged, or discharged other than dishonorably, active duty service members, reserve, National Guards, unmarried surviving spouses. The guarantee isn't perhaps as robust as the USDA guarantee, but still a very popular program, and obviously just looking at the loan numbers from 2017, active program, lots of participation in this program. So I just wanted to point out some other sources and considerations for accessing capital for buying a home. FHA became a primary lender during the recession, and again, FHA being the Federal Housing Administration, down payment requirements as low as 3.5%, but was a very active kind of go-to program when some of the other loan programs did dry up. State housing finance agencies typically are set up in each state. You think of many times the state housing finance agencies as being the designated entity to run the low-income housing tax credit program. But most of them have also become very active and have the bonding capacity to go out and raise capital for single-family housing programs. And again, those programs not just restricted to rural areas, but typically will be statewide. Many times they will get into, based on their needs in the state, they will get into targeting of particular individuals' households for some of their money. I've seen some programs that have been set up many times for, particularly for first-time home buyers. You'll see programs that will be targeted to teachers, firefighters, police, to workforce housing. Many times their programs will be set up for gaps between wages and home prices in certain areas of the country for essential service workers, where they need the employees for just running the communities and essential services, and so they're providing not only down payment assistance, but many times some subsidized rates, low rates and different programs available to get people into housing. Down payment assistance has become popular in many states, and so you'll have the housing finance agencies would be probably my first look to where some of these down payment assistance programs might be available. You have individual communities that will be using some of their pass-through funds and some of their own funds in some cases for down payment assistance. You'll see some of the federal home loan banks be also available in making down payment assistance because of the high cost of housing and because of trying to bring down basically the cost of the housing, help with that, that initial front end. And these commitments on down payment assistance can be anywhere from a few $1,000s, $5,000 up to as much as $50,000, depending on the area of the country and who's running the program and what resources they have available to them. As most of us know, credit counseling has become essential for home ownership, particularly for first-time home buyers and for lower-income households. And with that comes credit repair. And being able to understand credit reports and FICO scores. Some programs do not rely on FICO scores. Many say they don't, but they actually look at them anyway to see what they are. This is all part of the financial educational piece of working with clients, working with potential homeowners, that they understand their credit, they understand what they're getting into. Credit reports can be free on a one-time basis each year. December is a good time to order one if you haven't, because next year you can order one again and see where you stand. We've all seen stories of Equifax and some of the other credit reporting agencies that have had security breaches. And so even if you're not buying a home, it might be good just to check your FICO score, check your credit reports. There's some listings at the end of some links to how you can get to credit reports, FICO scores that won't cost you anything. And just to kind of be aware of where you stand, whether you're pursuing a home today or in 2018, and kind of sizing up what you may need to do. It's never too early to start on credit counseling and figuring out where you are on a budget and what you can afford. So in summary, there are multiple programs and obviously lots of lenders out there, and lenders that can be different. Many times the rates are going to be very similar, but you're going to have lots of advertising, you're going to have lots of marketing, you're going to have lots of teaser rates to get you in the door. So it's always going to be a good policy to shop around, understand how rates work, how people are marketing their programs. It's a good time to buy a house. I bring these subjects up at kind of at the end of 2017 on some of the issues that we talked about earlier. But we're kind of in a unique environment right now where we've gone through the big downturn and are now starting to head up, as you're reading the paper and seeing on the news that home prices are starting to rise again. They did hit some bottoms, but you're starting to see some very competitive offers out there for homes. There's not a large inventory of single-family homes out there. Perhaps because a lot of these homes that were foreclosed and went into inventory got bought up by investors and put back out there as rentals, so they have not come back on the market yet and may not for a while until prices continue to go up. But at the same time, as prices are starting to go up, we still have a very low interest rate environment, which is good for everyone. Probably, though, just like home values and home prices, you're probably going to see interest rates start to go up. I have no crystal ball to say when. I thought they would have gone up by now, but we do have low unemployment. We do have low inflation. We still have stagnant wages. So these are all issues that have to be kind of factored in, but you probably will not see interest rates this low in the foreseeable future. I'm hoping they stay low, but this is a good time to start looking at a potential home purchase now maybe more than ever if a lot of the other issues that we've talked about kind of line up. Digging into your credit scores, FICO, understanding those now, really credit counseling, if credit repair is needed, really starting now on that process. Sometimes it can take a while. Compare programs, try to figure out what's best for you and your household, and ask questions, know all the costs going in, closing costs, and not only some of your budgeted costs, but some of the costs that you might need just to get into the home itself. And then look at some of the down payment and closing cost assistance that might be out there. So with our programming at Enterprise, we do work with tribal communities. And so I did want to mention also before I end this session that we, working with tribal communities, we do work with the HUD Section 184 program, which is a single-family housing loan guarantee program, 100% guarantee, but it is restricted to enrolled members of federally recognized tribes. So if you are a tribal organization or you work with tribal organizations, tribal members, this is a good program to take a look at. Again, it's private lenders who are doing the paperwork, who are applying for the guarantee, and it has a restriction as far as who they can loan to, but the program works very well on both fee simple land and on trust land. It has some low down payment requirements. You can use this loan anywhere, not just in Indian country, but you can use it in cities. You can buy condos with it. It has a fixed interest rate. The rate is assumable, which is a great feature. It has liquidity for the lenders, and it is a program that is being promoted and looked at more and more to help tribal members get into home ownership and build equity in a single-family housing purchase. Just to wrap up, I wanted to make a few comments about infrastructure. Infrastructure for new construction is very expensive in rural areas also. And I'm not going to spend a great deal of time on this because of what I consider to be, as I look around and visit communities, quite a few opportunities to look at existing lots, vacant lots, and empty land that already has water, sewer, and much of the infrastructure to it. I run across subdivisions all the time as I travel around the country of lots. They were built, subdivisions that were built during the bubble. The housing market went in the tank, and now you have lots that are out there, some of them discounted significantly, some of them owned by banks and financial institutions, and they're trying to sell them. So just as an organization, what you might want to do in your footprint of your service territory, you might want to call around and start inventorying and just getting an idea of what's out there before you start thinking about trying to take a piece of land and work with the community and try to develop a piece of property for single-family housing subdivision. There may be opportunities that are already out there, and they may come at some significant discounts. Community assistance is always good to look at from the standpoint of infrastructure. CDBG funds, TIF, tax incremental financing districts. School districts can be a big source of support because every school district, particularly in rural areas, when I talk to them, are very much aware of their enrollment and very much aware of which direction that enrollment is going, up or down, always trying to attract families, children to their school district to make sure that they'll be sustainable in the future. there's a long lead time with infrastructure and putting infrastructure into place, water, sewer, streets, and such. Need and demand many times, though, will force you to look at infrastructure issues and building out new lots. But I'm a big promoter of doing it in a knowledgeable way, in a way so that you're using mixed-use land development, land that is not just for industrial, not just for single family, but multiple uses, and working really community-wide and making any new infrastructure work for the community, work for everybody. So with that, I didn't leave a whole lot of time for questions. I apologize for that. I am available via email, via phone, and get many inquiries over our website also. So feel free to contact me. We have a great staff at Enterprise that works in the rural sector. I did put some links out here, USDA link on some of their loan information. It's always good to check and see what they have there. There's a link to finding current market rates, whatever they happen to be on a daily basis, and they'll send you an email with daily rates as they change. You can get free FICO scores on one of these links, and they'll give you updates. And it will not affect your FICO score by getting a FICO score from them. So that sometimes is a concern. VA has a website on their loan program. Again, there are free credit reports available from the 3 major credit reporting agencies, and December is a good time to pull one down. You get one free one from each agency per year. This is December, so why not take it now and review it and then get another one next year. I put in the action campaign that Enterprise runs jointly with the NCSHA, but this will give you some updates, some action alerts on some of the funding issues going on in Washington, D.C. A lot of it's rental housing oriented, but there are also issues over single-family housing and just some of the programming itself. And then there's a link to HUD on the housing counseling providers that are around the country. So with that, I'll stop. And I know, Donna, I did not leave time for many questions, but if there are any, I'd be glad to. Otherwise, I am available at the email or by phone anytime you'd like to reach out. With that, I thank everyone for attending, and happy holidays.
Great. Thank you, Russ. And we have one question in, but I will forward that to you via email so you can get back to that person since we are at time. So with that, I'd like to thank Russ very much for his presentation, and I'd like to thank you, our attendees, for joining us for this Enterprise Live Online event. We hope you found it useful, and please fill out the survey form when it comes up. It really does help us with those. And with that, have a terrific weekend, and we hope to see you online again soon. Goodbye.